Do something today that your future self will thank you for. This quote, attributed to an anonymous source, perfectly captures the essence of strategic financial planning. Making intentional decisions now can secure greater rewards and financial freedom in the future. Hi, everyone. My name is Sean Riley, and I am the owner of GatherWealth Investment Management. In today's video, we're diving into a strategy that could have long-term financial benefits, Roth conversions. If you're unfamiliar, a Roth conversion is the process of transferring money from a traditional retirement account, such as a 401k or a traditional IRA, into a Roth IRA. While you'll pay taxes on the converted amount, the benefits are significant. Your money grows tax-free, and qualified withdrawals in retirement are also tax-free. So why is a Roth conversion such a popular strategy right now? Well, it's all about tax savings and financial flexibility. If you expect to be in a higher tax bracket in the future, or you believe tax rates will increase, converting now at today's lower rates could be a smart move. Plus, Roth IRAs don't require minimum distributions, RMDs, during your lifetime, giving you more control over your retirement funds. And there's another advantage. Roth IRAs offer a tax-efficient inheritance strategy, as they can be passed on to beneficiaries without triggering income tax withdrawals. As your IRA balances grow, it's essential to think about potential tax implications. Roth conversions can play a key role in addressing some of these challenges. Here are 3 critical factors to consider. Required minimum distributions, or RMDs. Once you reach your early to mid-70s, you're required to take distributions from your traditional IRA. These RMDs are taxed as ordinary income, and the larger your balance, the larger your required withdrawals. This could push you into a higher tax bracket and increase your overall tax burden. Number 2, Medicare premiums. A higher taxable income from RMDs could trigger income-related monthly adjustment amounts, or IRMA. This leads to higher Medicare premiums for Part B and Part D. Even a small increase in taxable income could result in significantly higher healthcare costs. Number 3, the widow's tax trap. For married couples filing jointly, tax brackets are wider. However, after the death of one spouse, the surviving spouse may face higher taxes as a single filer. RMDs and other taxable income, including Social Security, could push them into a higher tax bracket, and this compounds the tax burden. Managing these tax challenges requires careful planning, and Roth conversions can be an important part of that strategy. By timing withdrawals and working with your financial advisor, you can minimize future tax impacts. In this video, we'll explore the key reasons to consider a Roth conversion and look at a real-life case study to see how this strategy could enhance your retirement plan. Let's look at the benefits that Sammy and Sarah could receive from a Roth conversion. Though Sammy and Sarah are fictional characters, their situation is relatively common. They've saved well and regularly into their retirement accounts. When we look at Sarah and Sammy's financial makeup, we'll notice a couple of things. Their savings into their retirement accounts are pretty robust. They both have 401ks. Each of these is a traditional tax-deferred 401k, and they have IRAs, again, tax-deferred IRAs. They do also have a brokerage account, which consists of a diversified mix of stocks and bonds. When we look at Sarah and Sammy's goals, we'll recognize that they intend to retire at the ages of 65, and they intend to spend about $8,000 after tax each month in retirement. Finally, they'll have these healthcare expenses, and the reason we separate the two costs is because they tend to inflate at different rates. Living expenses, the inflation rate is between 2 and 3% historically for everything that's not healthcare. And for healthcare, the rate of inflation is historically between 5 and 7%. So the first thing we want to take a look at is what's the likelihood that Sarah and Sammy have everything they need to retire confidently at the ages of 65. And when we look at their situation and we project forward using the expected rate of return on the portfolio as it is designed, We consider the fact that they continue to save into their retirement accounts and that their current living expenses will be slightly higher, perhaps for the fact that they have debt that they still need to pay off, like a mortgage. And then moving into retirement, they have this $8,000 expense plus healthcare. So if we're right, and again, it's important to point out that these things could change in time, and that's why we continually review with our clients their planning needs. But accepting for a moment that these things can change, at least for now, we have actually a very high confidence that everything is going to work out pretty well for Sammy and Sarah. So the next step would be to determine if their plan could be enhanced by incorporating Roth conversions into their retirement planning strategy. Couple of things to point out with this graph that we see. So each of the lines here represents a level of taxation. In the United States, we have a graduated or progressive tax code. So as you earn more dollars, your rate of taxation goes up. One of the things I would point out here, though, is there's this period of time between now and when they reach the age of 65, when their incomes, as represented by the shaded blue area, are slightly increasing with each year that passes. Then there's this dip. There's this period between when they retire and when they start to collect Social Security and their required minimum distributions, where there may be an opportunity for Roth conversions, again, for taking income from the traditional tax-deferred accounts and converting that into a Roth. You'll also note that as the years go by, so too do the changes in the amount of income they receive. Their income is going up. And actually, in the very final years, their income is significantly higher than it was earlier for the fact that they have to take these required minimum distributions. So again, if the approach is, let's receive some of this income in advance of those later years in the hopes that improves the economics of their situation, we can simulate that. We can model that. And one of the things we might do is start to realize income up to the next layer of taxation. So in their case, when they turn 65, their income drops off. But what if we were to convert traditional dollars into Roth up to the 12% tax bracket? Well, if we did that, a couple of things happen. In this case, there's dramatically more assets at the end of the plan than if we hadn't considered this strategy. So here in this green shaded area, which I will expand, you'll see those Roth conversions. And again, you'll see them to the extent that we want to recognize income up to that 12% bracket. Because we did this, and because we avoided higher levels of income in those later years, we actually saw a positive outcome. In this case, roughly $670,000 in tax-adjusted ending assets. Now, that term tax-adjusted is rather important. And the best way to kind of describe it is to think of having $1 in a tax-deferred account and having $1 in a tax-free account. The dollar in the tax-deferred account is actually worth less than your dollar in the tax-free account, because to get to that dollar in the tax-deferred account, you first have to pay taxes. So you would discount the value of that dollar for the taxes you're obligated to pay as you're taking it out of the tax-deferred account. And so if we look at a comparison, not only, and this is just a reflection of the invested assets over time, not only do we end up with more in ending assets by about $260,000, when you consider the value of those dollars is higher for the fact that they're sitting in a tax-free account, that's pretty compelling. I think it's important to remember the goal of any tax strategy is to pay the least amount in taxes over a lifetime, not just in any given year. But let's take a look at a couple of the other benefits that come with a strategy like this for Sammy and Sarah. If we look at the amount of taxes paid over the rest of their lives, we actually see that we're saving over $600,000 in federal taxes because we realized some of that income in years where we weren't being taxed at a very high rate. Additionally, our required minimum distributions, again, those dollars that we're forced to take out of a tax deferred account, are fewer by over $2 million than they would have otherwise been if we didn't employ this strategy. Finally, tax adjusted wealth, that description I had earlier for this benefit that comes from moving dollars into the tax-free bucket. If we look at what our heirs would receive, recognizing that this is based on a projection about the rate of taxation they'd be exposed to. But if we're right about our assumptions, before conversion, the amount of tax-free dollars left to that next generation is 6%. After we employ this strategy, it's 24%. Now, we can get even more aggressive in our approach to this, but there are consequences to doing so, and each of those has to be carefully examined, understood, and then we move forward. Beyond the benefits that we see clearly here for Sammy and Sarah, digging into some of the details, here is how we would go about converting in those years when taxes are at their lowest for Sammy and Sarah. These are the dollars we're converting, and this is the sum of money we're pulling from the tax-deferred accounts. So if we look at the tax details for that period of time when we're doing these conversions, as we would expect, the system is capping our withdrawals to the extent that we stay below that next layer of taxation. Here we are reporting income at 12%. For some, the case is very clear. The Roth conversion could indeed be a very good strategy to employ as you consider the best way to enhance outcomes and pay less in taxes over the course of the rest of your lives. So often, however, clients will come to us and say, well, if that's the case, shouldn't I convert every tax deferred dollar that I have? Shouldn't I put it all into a Roth? Because I can be even more aggressive in my approach to conversions. And yes, but there are several important reasons to approach Roth conversions with a strategic plan. Converting your entire traditional IRA balance to a Roth IRA at once may not always be the best choice, as it could prevent you from taking advantage of lower tax brackets in retirement. Here's why. The U.S. tax system is progressive, meaning different portions of your income are taxed at different rates. In retirement, some of your income might actually fall into the 0, 10%, or 12% tax bracket, much lower than higher tax rates. Required minimum distributions from a traditional IRA are taxed as ordinary income. However, depending on your overall income level in retirement, some of your RMDs may fall into those lower tax brackets. If you have little other taxable income, you could pay 0, 10, or even 12% on a portion of your RMDs. When you convert to a Roth IRA, you pay taxes upfront on the amount converted at your current tax rate. If you're still working or you have other income, converting a large balance could push you into higher tax brackets, 22, 24, even higher. This could mean paying more in taxes now than you might need to in retirement when your income may be lower. Rather than converting everything all at once, it may be more beneficial to convert enough each year to fill up your current tax bracket without pushing you into higher ones. This allows you to enjoy the benefits of Roth funds while keeping some traditional IRA dollars to take advantage of the lower tax rates when RMDs begin. In summary, converting your entire traditional IRA balance at once could result in higher taxes now, while also missing out on the lower tax rates available for future RMDs in retirement. A gradual, tax-aware conversion strategy can help strike a better balance. Now, looking back at our case study, Sammy and Sarah's situation, this shows the compelling benefits of strategic Roth conversions. Again, converting up to a certain tax bracket for them makes a lot of sense. For everyone else, a careful examination of your situation will reveal the pros and cons of a strategy like this one. Thank you so much for watching. If you're a small business owner, creative entrepreneur, someone seeking personalized financial guidance, we'd love to help you navigate your financial journey. Whether you're looking for retirement planning, investment management, or advice tailored to your unique goals, our team is here to support you. Feel free to reach out to us through the links in the description, and let's start building a financial strategy that works for you. We look forward to connecting with you. Thank you.